let's chart this out on a P&L graph. So this is the iron condor. And as you can see, we have the wide wings, okay? Where the butterfly was more like a teepee, where we really needed that stock to close right at our short strike. Now we have more room for potential for the stock to trade. Once again, we have two break evens, okay? We have a break even of 141.70 on the downside and 158.30 on the upside. Ideally, we would like the stock to close between 145 and 155, but if it's closed anywhere between our break evens here, we would still have some type of profitable position. Our maximum profit in this case is the 330 that we took in, and that's if the stock closes between 145 and 155. But all options would expire worthless. But once again, remember that if the stock closed at 155 or 145, we'd probably want to buy back, or at a minimum buy back those short options where the stock got pinned, just so we didn't have any expiration assignment risk. Our maximum loss, well, that's if the stock is outside of our wings, our long strike. If the stock is above 160 or below 140, that's where we would lose the maximum possible loss of 170 or 170 per spread. Okay, so once again, this is a way to take advantage of high implied volatility or elevated options prices if you're of the opinion that the stock is going to kind of trade in a range-bound way right around, in this case, these break-even points. And those break-even points, we are arriving at those because we took in the 330 credit, and that is the maximum profit that we can make on this position. Okay, so in some key takeaways. Okay, once again, the iron condor combines a bear call credit spread and a bull put credit spread, 4 legs at different strike prices. The maximum profit is always going to be whatever net premium income that we take in, and that's achieved if the stock finishes between the two short strikes, the call and the put, at expiration, less any commissions that we might have to pay. The maximum risk is always going to be the difference in strike between the calls and the puts, minus the premium income received if all the strikes are equal distance apart. Ideally, we use this when implied volatility, the iron condor, when implied volatility is elevated with somewhat of a neutral or range-bound forecast. Once again, if implied volatility were rather cheap and inexpensive, we might consider either a call condor or a put condor rather than the iron condor. The position monitoring is always crucial, once again, due to that assignment risk, especially if the underlying is close to one of our short strikes at expiration. And once again, you're certainly free to take this position off early. If, all of a sudden you put on this iron condor and you got like 3 days to go to expiration and the iron condor is trading for 30 cents, you could just buy back your wings, your short wings for, 30 cents or less, and just take it off and just walk away with a $3 profit in this case and not have to deal with expiration. So you're certainly free to close the position before expiration, but you can always carry it to expiration if you so choose. Okay, so that is the end of our presentation. So